And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. And you know, folks, spring is coming. And with the vaccine and the reopening story all emerging, a lot of people are starting to think about real estate. What's going on with interest rates? How's it impacting the ETF market? That's the big question right now. Let's talk to three men who might know about offices, shopping malls, cell towers, things like that. Michael Larone is the Chief Investment Strategist for the Spiders ETF at State Street Global Advisors. He runs their Real Estate Select ETF, XLRE. Leighton Spar is the President of Alps Advisor and runs the Alps Active REIT ETF. The symbol is REIT. It just started trading on Friday. And my old friend Todd Rosenbluth is from CFRA, all-round ETF expert. Michael, I want to talk about Reits a little bit and real estate, but specifically about investing in real estate using real estate investment trusts or REITs. Just to make sure everybody's on the same page, could you briefly explain what a REIT is exactly and how it sort of differs from real estate investing in general?
So a REIT is a company that owns, operates, or finances income-producing real estate. So really what it allows the investor to do is share in the income from real estate without having to buy the property, manage the property, or finance the property. More than 145 million Americans own REITs in their 401ks or other investments that they have, other investment portfolios that they have.
Yeah. And I know just on rising rates, there's some worries out there for stocks here. Now, how does rising rates affect REITs? I mean, REITs pay dividends. They compete for rates. They compete for the person who's investing based on getting yields. What happens when rates go up, and how does it affect REITs?
So typically what happens, because REITs are required to distribute 90% of their income back to investors, that yield is attractive. And so when rates are rising and there are other choices for reliable income, sometimes investors leave REITs to capture kind of more reliable or more at least perceived to be safe income from that standpoint. But what's interesting here so far is that this year, as interest rates have climbed, REITs still have attracted about $1.5 billion real estate or REIT ETFs inflows, more than 3% of their total asset value. And actually, prior to today's action, REITs have been outperforming the market, the S&P, by a little bit. And I think two things are really driving that. It's the reopening trade in terms of folks expecting more people to be at malls and back in the office. And I also think it's inflation. And so typically, both rents and the value of real estate goes up when prices go up. And that's attractive for a REIT holder.
Bob.
Yeah, Todd, what do you make of all? Go ahead. Yeah, what do you make of that? I mean, I know obviously there's been inflows into REITs too as well. That also is very interesting.
Yeah, I think what's also very interesting is when we dig into the REIT sector, which is roughly about 2.5% of the S&P 500. You've got a split, as Michael was talking about the reopening side of things. So hotel and resort REITs are up 13% as of Friday. You've got residential REITs that are up 8.5%. You've got retail REITs that are up 18%, whereas office REITs and industrial REITs are down year to date. So there's a broad market cap weighted approach that Michael's firm XLRE offers, and then you've got either an equally weighted version that Invesco offers, or you've got twists on this. NETL is an example of an ETF that focuses in subsets the marketplace that from an index-based approach. And of course, we now have a new active ETF.
Yeah, that's very important, I think. And Leighton, speaking of actively managed ETFs, you've got one, just started trading Friday. I can't believe REIT was never taken as a symbol, but apparently you guys have it. What parts of the real estate business do you think are going to deliver the best returns in 2021? Now, we obviously know the old traditional ones, the apartments, the offices, the industrial, the retail, but a lot of the business, a lot of the real movement in the last few years has been in these data centers, in cell towers, for example. So there's some subsectors. What's interesting to you in REITs this year?
Yeah, I mean, the whole space after, derating, by a couple multiple points last year relative to the S&P 500, for example, that actually saw multiple expansion. looks pretty good. And I think there are opportunities on both sides of a barbell where you can look at the mean reversion type trades that, Todd was just talking about with retail and malls. On the value side of the equation, we do like the apartment sector. We do think as we reopen, the labor mobility, the normalization of what, job growth looks like, all of that's good for people moving around, and apartments will thrive again, in our opinion. And the other side of that coin is storage. That as jobs are created and people start to settle back into a new routine, they have to move, and storage and movement go together. One thing I think that's important about the dividend yield story, though, last year that correlation between interest rates and Reits, really broke down. As we saw rates plummet, Reits also underperformed. So, they didn't benefit from the lower rates that we saw through most of last year. So I think that reversion this year, whereas rates started moving back up, Reits outperformed. What that's pricing in is an expectation of growth in rents. And, when you're looking for income, you have to think about what the real income is going to be. And growth within REITs is definitely a benefit for more yield-oriented investors.
Right. Now, you have, this REIT that you're running, that you just started, is an actively managed, non-transparent. So you guys are actively picking stocks. You're not relying on, some particular index, and it's not transparent. Explain a little bit about what that means to our viewers. We see what's in the portfolio, but we don't know what the percentages are. Is that right? And you report quarterly what the actual numbers are?
Yeah, so we like to call it semi-transparent because the market can see the securities that are in the portfolio, but they don't see the exact weights that we're implementing. And the reason that is that we run a fairly concentrated portfolio, around 40 different names. Oftentimes we'll have more than a third of the portfolio in the top 5 names. And so obviously when we're changing our view and we're moving those active positions higher, we don't want to signal that to the market immediately, but we do want to be able to give our authorized participants and market makers enough visibility that they can successfully hedge and provide liquidity around the ETF. So semi-transparent is the label that we think through, because you can see what's in it, you can hedge it very easily, but you can't front run it, right? So it protects the intellectual property that's in the portfolio. And so it's like a mutual fund in that you don't know exactly what the portfolio manager is doing until 30 days after the end of the quarter. But the benefits, we all know the benefits of ETFs, and now we can do it with an active structure. So, yeah, that's how we think about it.
Todd,
it's been trading for 2 days. So,
right. Todd, update us on actively managed non-transparent. It's become more of an issue. It's become more of a high-profile thing. Contrast the advantages and disadvantages. Kathy Wood is actively managed transparent. You can see everything that's in her portfolio. Others, like this one here, you can't see exactly what's in it. It's only semi-transparent. Is there advantages and disadvantages here?
Well, the advantage from the portfolio manager, as was touched on, is they can move in and out of positions without having to disclose each day that they bought a little bit more of that or they're paring back on an individual name. We just think that actively managed equity ETFs are gaining traction. You talked about Kathy Wood, and I know you've talked about the ARC funds in prior shows. We're seeing firms like American Century and T. Rowe Price and Fidelity and Invesco, other large asset managers that are taking strong investment strategies and making them available from a tax-efficient perspective for ETF investors. So I think it's really exciting that we now have an active REIT approach to it for someone who wants a low-cost index-based strategy. State Street and others have that. Now active management exists in a REIT wrapper too.
Yeah. Michael, yours is not actively managed, XLRE, but it has some very concentrated holdings in tower stocks, for example. I look at your top holdings, American Tower, almost 12% of the entire fund here. They lease cell phone towers, essentially. Prologis is a distribution center and warehouses, so it's a little different. But Crown Castle, that's another one. That's a cell tower provider. And there's some other ones in there. Digital Realty is a data center. Simon Property is a mall owner, so it's a little bit of a mix. Now, I know this is market cap weighted, but the market seems to be saying it really likes cell towers these days and it likes data centers.
Yeah, Bob. So exactly right. It's a market cap weighted index. We're simply seeking to match that index. And as you're rightly pointing out, if you think about the kind of corollary here, as Apple has grown, as smartphones have become more prevalent, and technology, Amazon in terms of and kind of Facebook and others, not surprisingly, there's a commensurate increase in the need for communications infrastructure, for towers, for data storage. And not surprisingly, these are some of the biggest names with the index. And you mentioned a few of them: Crown Castle, American Tower, Digital Realty Trust. Now, one of the things that has been interesting, and I think Todd was describing this a little bit as well, is we have seen, similar to the market this year, there has been an underlying rotation in terms of performance. And so, Digital Realty Trust was a big winner last year as the stay-at-home stocks really did well. But since October, we've actually seen Simon Property Group climb more than 80%. It's the largest mall operator in the U.S. So as the economy is expected to reopen, as vaccine distribution progresses, folks are expecting the consumer and retail to rebound. We're starting to see that, and you could also see that Simon Property Group is one of the bigger names in the index as well.
Right. So, Leighton, you've got the sort of burden of doing the active management part, and this is the hard part of active management. I think of healthcare, for example. There were some very successful healthcare managers in the 90s and 2000s, and what they had to do was rotate between managed healthcare, pharmaceuticals, biotech, medical devices, and how well you could maneuver in and out of those kind of determined how successful you are. That seems to be the same thing with REITs today. You've got the old standbys of apartments and offices and industrial centers, but you've also got data centers, self-storage, what we were just talking about there. What methodology do you follow to determine how the weightings are going to be? Can you just be a little more specific?
Yeah, and the burden of proof in REITs is actually a little easier to bear than in most places in the equity market when we're trying to support active management. And when you look over long periods of time, 70% of active REIT managers have outperformed their benchmarks over the last 20 years. If you look over the last 3 years, it's closer to 55%, but it's still more than half. And that's pretty unique for active management, right? Equities in general see active management underperform. And I think what allows active REIT managers as a group to do well is a focus on value. And, real estate is still a mean reverting category. It's different than healthcare in that it doesn't have, the enormously, complicated regulatory structures. It doesn't have the huge innovation breakthroughs that we have that really disrupt an industry. Real estate evolves fairly gradually, and because of that, you can look at it as an active manager, and you can get a sense of longer-term trends, right? And you can play against the momentum that may take a data center or tower stock, for example, right now to very, very big market caps, and you can start looking back at some of the areas that have lagged over the last few years, like apartments or retail, and that mean reversion is pretty powerful. So what we're looking for from a specific construction standpoint is value, right? Well, we can look at a stream of rents. We put in some fundamental view about how those rents are going to change. And, then we look at growth versus the interest rates that you have to capitalize real estate. And that fairly straightforward value orientation has worked in real estate, and we think it will continue to work. And, when we look at it versus the bond market, yes, low interest rates are really critical for the financing piece of it. But if we do start to see inflation creep back into the economy, rents grow with or faster than inflation, which is the big advantage versus the fixed income portion of an allocation. So, we're thinking about growth, right. We're thinking about value. We put them together, and it's worked.
Yeah, so your basic pitch here, Leighton, and Michael, jump in if you want, but is rents are growing higher than inflation right now, and that's going to ripple right across the entire REIT value chain. Is that the main point you want to make here?
Yeah, we've got yields in the 3 to 4% range, and we think those dividends can grow 4 to 5%, which is faster than inflation. So from an income standpoint, we've got a nice tailwind.
Right, Bob.
Right.
So
Michael, let me go ahead.
So just picking up on Leighton's point, if you look over the last 20 years, REIT dividend growth has outpaced inflation in nearly all of them. So again, as income is really scarce right now for investors, and it looks like in terms of the challenges on the fixed income side of things are going to be with us, rising inflation, rising interest rates, which puts downward pressure on bonds. This kind of stable, reliable income stream above inflation is really attractive to investors. And I think that's part of the reason why you've seen ETFs attract flows there, and the performance is held in pretty strongly as well.
But Michael, let me just go to the office thing because I want to. Go ahead, Todd.
No, I was just going to say, well, to piggyback onto it, what we've seen from a flow standpoint, we are seeing REITs among the more popular sector ETFs. We have some financial ETFs that are leading, like XLF and KRE, which is a regional banking ETF. But REIT ETFs rarely are at the top of the sector leaderboard. I think it's a sign that REIT ETFs are balancing both the growth as well as the defensive characteristics. The REIT sector has a beta of about 0.7 versus the broader market. A little bit defensive, but nowhere near as defensive as utilities or consumer staples.
Yeah. I mean, you noted to that in our discussions earlier, Todd, that REITs had been successful pulling in some significant flows in the last year to date so far. Michael, I want to talk about COVID and the return to offices. We haven't touched that on at all. Or Leighton, if you have a thought on this. What is going to happen? I mean, the rollout of the vaccine is accelerating rather dramatically now. We are seeing a third vaccine that will be delivered within the next week or two. It seems like the reopening is really proceeding apace, and this is why the reflation trade is doing so well. Certainly by May, a significant part of the population is going to be vaccinated. What is the REIT industry saying about the return to offices at this point? How are they preparing for that? And is it going to be somewhere in the middle of people going back full-time and part-time?
Right. I think that we will be getting more people in offices as the year progresses, as vaccines get more widely distributed. But we're not going back to the pre-pandemic kind of way of life anytime soon. So, there'll still be fewer people in those offices. I think companies have sought to do a number of things to more efficiently manage their businesses, including their real estate footprint. And that trend's likely to continue and put some downward pressure on the office REITs in particular moving forward. But you could see some kind of snapback, mean reversion, as Leighton was describing, in terms of as the economy recovers and more people get back, that should help. But I think we're a long way away from being kind of in a position of strength.
Yeah, that's the one sector, Leighton, don't you see underperforming for a while? I don't know how you can make an argument that rents are somehow going to go up in the office space area. Are you not making that argument in this particular subsector, are you?
No, I mean, we're similarly cautious on office. And, the people that are most optimistic about the recovery in office space are the landlords of those office spaces. And, when we talk to CEOs that are not in the REIT industry, I think they're much more cautious about what they're going to do with their office footprints. I was actually talking to a CEO that was testing this theory that FaceTime is going to matter again, and there's a competitive push to be back in the office. And everybody else in the conversation, kind of said, I don't see that happening. That young people in particular, they make their influence online as well as they do in person. So, I think some of these behavioral changes around how work is done and where work is done are long-term. So we're not a big mean reversion trade within office space, but we do think in retail and malls, there's some innovative ideas of how to make those spaces functional again. And that ties back into industrials, right? And the omni-channel movement of goods around the world needs space. And, malls can be repurposed for a lot of things. They're fairly general. They're located all over the place. So if you're going to play deep value, we like retail and malls better than we like office.
Yeah, I mean, you could just look at I don't know, pick one of them. Boston Properties, for example. Those office REITs have notably underperformed, even XLRE, for example. So I think that's a hard argument to make. I can certainly see how you can make an argument of rising rents in storage, rising rents in the Prologuses of the world, in data centers, anything like that can certainly, even towers, I think would make an argument for rising rents. I don't see that in the office space. Guys, we're going to have to let it go with that. Interesting discussion, as always. That's it for this week's ETF Edge. And thanks to Todd, as always, and to Leighton and Michael. Michael's going to stay with us for a few minutes. We'll have more on the ETF Edge podcast, talk a little bit more about the real estate reopening. And remember, you can see all of our, of course, videos on our website, etfedge.cnbc.com. And remember, next week, we're going to have a special discussion about whether you can time the markets using ETFs or anything else. Is that even a feasible idea anymore? Using stocks, ETFs, anything. Wide-ranging discussion on where the market might be going in the near future. That's it for ETF Edge. Everybody have a healthy, happy, and safe trading week.
ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds. Expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.